Hello and welcome to another video on Ind AS series from GJ Management Consultants. So today we are here to present on Ind AS 28, which is about investment in associates and joint ventures. So the key topics that we are going to cover today are the objective and scope. We'll quickly have a look at some of the key definitions. We'll talk about what is the definition of significant influence when we are talking about investment in associates and joint venture. We'll also look at what value or what basis initial recognition happens. What is the methodology for subsequent measurement? What is the concept of impairment of asset when we are talking specifically about Ind AS 28? We'll also talk about the treatment of OCI of JV and associate. We'll look at the treatment of unrealized profits, discontinuation of equity method, which is the method at which the investment is recognized for investment in associates and joint venture, and then the disclosures, and finally we'll end up this presentation by showcasing differences, if any, between Ind AS 28 versus equivalent IAS 28. So we'll quickly move to the first slide then. Okay, so we'll quickly talk about the objective and the scope of Ind AS 28. So Ind AS 28 deals with situation when an entity has an investment in the another company, and that another company is either an associate or joint venture to this. And this accounting standard, this Ind AS specifically talk about how we have to do the accounting for that particular scenario, and it covers the two specific areas: associates and joint ventures. And scope also, when we look at the scope, it applies to associate joint venture, but it exclude two specific area wherein the investment in the another entity is such that another entity becomes a subsidiary of the first, which is like parent. A parent is holding investment in the subsidiary, which is over and above, or let's say which is not equal to either the joint venture or either the associate. And second scenario, when investments are held by the venture capital or the mutual funds, which is measured at FVTPL, which is fair value through profit and loss account. And when we try to compare the objective and scope of this standard with equivalent Ind AS, IAS 28, they are same and there is no gap. So we'll move to the next slide then. Okay, now we'll quickly have a look at some of the key definitions which are important with relevance to Ind AS 28. So first one is associate. So an associate is an entity over which the investor has significant influence, but not control. This is most important because it has to be significant influence, which means that it has the significant influence to take the decisions for any policy or any financial decision, but it cannot control those decisions. It can make the proposal, it can make the recommendation, but it does not control the outcome of the decision, which is a scenario wherein an entity holds a substantial amount of the voting share, or it has a substantial control, and that another entity becomes a subsidiary, which is largely guided by Ind AS 110. A joint venture is a joint arrangement whereby the parties have the joint control. So if it's a particular business, there's a joint venture wherein both the parties have the joint control over the operations, then definite or net asset of the arrangement, then this is a joint venture. Joint arrangement is an arrangement on which two or more parties have the joint control. Joint control is what? Is a contractually agreed sharing of the control arrangement which exists only when decisions about the relevant activities requires unanimous consent of the parties. So which means whenever we have a joint venture, there is a proper agreement. This is which a joint control scenarios is being built upon, and it is clearly articulated what is the definition of the joint control. And this is that it is to be determined whether the operations has the joint control, and then that has to be classified as a joint venture. Now, the most important thing that we have to take into the cognizance with respect to Ind AS 28 is the method at which the investments are recognized in the books of account. There is a method which is called equity method. It's the method of the accounting whereby the investment is initially recognized at the cost and adjusted thereafter for the post-acquisition change in the investor's share of the investee's net assets, which is nothing but the profits or the reserves. The investor's profit and loss includes his share of the investor's profit or the loss, and the other comprehensive income includes the share of investees in the other comprehensive income. So which means that equity method is a method in which initially investment is recorded as a cost, and then at every subsequent recognition reporting date, it has to be added or reduced with the change in the profits or the OCIs of the investee. And this is with largely to the share of the investor into the investees. So which means that if entity is holding a percentage share, then to that extent that percentage of share would be applied on the profits and the OCIs that will be included in the profits and the OCIs of the investor. So this method is the equity method. We are going to have few more examples which clearly demonstrate that this how this accounting happen. This is the equity method when we are specifically talking about the Ind AS 28. And when we compare these definition with the relevant definition in the IAS 28, all these definitions are aligned. So we'll move to the next slide then. Okay. Now we'll quickly talk about the definition of the significant influence, because this is very, very important to understand. Because when we talk about Ind AS 28, it only arises when the entity has a significant influence over the investee. So as per the definition of significant influence, what does that mean? If an entity holds directly or indirectly through its subsidiary 20% or more of the voting power of the investee. 20% or more power of the voting power is the benchmark as per the Ind AS 28. A voting power of the investee, it is presumed that the entity has a significant influence, unless it can be clearly demonstrated that this is not the case. So conversely also, if entity is holding less than 20%, then it is assumed that it is not holding the investment in an associate. But if it has been proved that it has a control through any of the mechanisms, significant influence, then definitely it can be construed to be a investment in associate. And what can those significant influence would be? It is being shown in the next paragraph. So existence of significant influence by an entity is usually evidence. So how it is evidence whether an entity has a significant influence or not? Definitely we have talked about one rationale, which is the percentage, sorry, which is the percentage basis, which is the 20% or more of the voting power. Now we'll quickly have a look at the existence of significant influence by an entity is usually evidenced one of the most following ways: representation on the board of director or equivalent governing body, participation in policy decision making, including participation decision but about the dividend or the distribution, material transaction between the entity and his investee, interchange of managerial personnel, interchange of the managerial personnel, provision of the essential technical information. So which means that all these are the indicators which signifies that the entity has a significant influence over the another entity. These are largely being demonstrated for those specific cases wherein the entity holds directly or indirectly less than 20% of the voting power. Because if entity is holding more than 20% or more than the 20% voting power, then automatically the investee company becomes the associate of the investor. But if it is less than the 20%, then ideally these are the indicators that needs to be looked into to establish whether the entity has the significant influence over the other entity or not. And if it is established, then definitely the accounting and the recognition has to be adopted. This is the Ind AS 28. Okay, now we also talk about that the substantial or the majority ownership by another investor does not necessarily preclude an entity to have a significant influence. Okay, so we have to look judicially at each and every aspect to determine the fact that the entity is having this significant influence over the other. And what does the significant influence means? That it has the power to participate in the financial policy and decision and operating policy decision, but not control them. This is very, very important. There is no control, because when it is a control, it is a subsidiary. And we talked about this in that in the last slide also, when we're talking about the definition of the associate. So associate has the significant influence. If the entity has significant influence over the other entity, then it is presumed to be an associate or a joint venture. The control is not there. For control, it has to be a subsidiary, for which we have a separate Ind AS 110. And when we try to compare this definition with in the IAS 28, it is largely the same. So we'll move to the next slide then. Okay, so we talked about the concept of equity method. Now we'll quickly look at how the initial recognition happened. So initial recognition, investment is initially recorded at the cost, including the purchase consideration and the directly attributable cost. So which means that the price at which investment has been acquired by the investor in the investing company, that is the price at which the accounting will happen. That is called the initial recognition. So example, company A requires the 30% stake in company B for 10 lakh rupees. So entry would be investment in associates to bank, and this investment in associate is typically something which is shown as my non-current asset. and equivalent, and this is equivalent to my IAS 28. There is no gap. So we'll move to the next slide then. Okay, now we have looked at how it has been, how we have to recognize the investment in associate for the initial recognition. So let's just have a look at what will happen in the subsequent reporting period. So under the equity method, investment is initially recognized as cost. We know this. Carrying amount is adjusted for the investor share in the post-acquisition profit or losses. Investor share of profit and loss is recognized in the P&L, and dividend received are reduced from the carrying amount. So which means that carrying amount at the subsequent period would be equal to the initial cost plus share of the profit or loss for OCI minus the dividend received. So taking a quick example, investment cost is 10 lakh and let's say total value is 30% stake in the investee company. Associate partners is 4 lakh. Associate partners profit is 4 lakh. Dividend declared is 1 lakh. So carrying amount is 10 lakh. 30% of 4 lakh is 1 lakh 20,000, and we are receiving dividend of 1 lakh, which is 30% of 1 lakh, which is 30,000. Which is like the total value of would be in my would be 10 lakh, which is the actual original carrying amount, plus 1 lakh 20,000, which is the proportion share of the profit attributable, and minus 30,000 is the dividend that has been received. So carrying amount of the investment in my balance sheet would be 10 lakh 90,000. The profit share would be added to my profits of the investor company, and the dividend received would be added to my bank, because this is dividend actually received. And but my carrying amount in the investment would be 10 lakh plus share of the profit minus the share of the dividend. And this is equally aligned with IAS 28. So we'll move to the next slide then. Okay, now quickly talk about the impairment of the investment. So impairment is governed by Ind AS 36. So it has to be dealt with that Ind AS. The entire rules and regulation and the methodology would be governed by the Ind AS 36. Investment in associate and JV is tested for the impairment at each reporting date. This is to make sure, because we are recording the investment at the cost, and it has to be treated for the impairment. For example, we have a carrying amount of 10 lakh 90,000 as per the last slide. Recoverable amount is 9 lakh 50,000. So there's an impairment loss, and this impairment loss would be recognized in my PNL, in which there is a fall in the fair value less than the cost at which we are carrying the investments. So investor share of the losses, however, there's a situation when the investor share of the losses equal to or exceeds the carrying amount. So which means that if a carrying amount of my investment is 2 lakh, but the losses attributable to the investee is let's say 3 lakh rupees, then we have to recognize the losses only up to 2 lakh. The remaining 1 lakh needs to be ignored unless and until there is a specific obligation exists. So which means that our reduction in the carrying amount would be the equal to the losses. If my losses are more than the carrying amount, then it has to be fully write-offs, and then we'll have to write off all our investment in the books of accounts. So what is the treatment then? We have to stop recognizing the further losses, and unless the investor has a legal or constructive obligation. And we have to make sure that our investment should take cognizance of all the losses which has been incurred by the investee company. And this treatment is equally aligned with IAS 28. So we'll move to the next slide then. Okay. Now we'll quickly talk about the treatment of OCI of the JV and associate. So, I mean, there's no specific difference. The way we record the attributable portion of P&L, the same way we have to recognize the share of the OCI as well for the JV in the investor books of accounts. For example, associate records revaluation gain of 2 lakh. Investor share is let's say 60,000. So investment in associate will be increased. The carrying amount will be increased by 60,000, and the portion would be credited to my OCI. And this statement is absolutely aligned with in IAS 28. So move to the next slide. Okay. Now we'll talk about the treatment of the unrealized profit. So, see, typically what happens that when we are talking about concept of unrealized profit here, so which means that there are certain transactions which happen with the investor and the investee. It can be both ways. Investor is selling some goods to the investee or vice versa. So in both the cases, there is a profit element that is attributable, and there is a concept of unrealized profit because the few of the inventory which is being either sold by the investor to investee or the vice versa remains unsold at the end of the year, or there is some asset which is being transferred. In both the cases, there is a profit margin. So as the concept of Ind AS 28, that unrealized profit needs to be excluded from the investor books of account. So what does this is that Ind AS 28, because it's an equity method, profits and losses resulting from the transaction between the investor parent and the associate joint venture must be eliminated to the extent the investor's interest until the assets are sold to an external party. So once the asset is sold to the external party, then it has to be reversed, or let's say reinstated, which was reversed earlier. So why elimination is required? Equity method reflects the investor sharing the net assets and the result. Unrealized profit is not yet earned from the group perspective. Prevent the artificial inflation of the profits in the investment value. So type of transaction is upstream between the associates and joint venture, or downstream between the investor to associate. So it can be both way transaction, upstream or downstream. In which case the treatment is same. There is no difference in the treatment. The unrealized portion of the investor's share needs to be excluded in the consolidated financial statement of the investor. So we'll quickly have a look at the example for both these scenarios. But when we try to compare this with IAS 28, it is absolutely aligned. So we'll move to the next slide to look at one example each for the upstream and downstream. Okay, now we quickly have a look at the example for both this scenario. So first scenario is when the parent is selling goods to the associates. So take the example that P sells goods of 1 lakh, P is the parent, A is the associate. Cost of goods sold is 70,000 and unrealized profit is 30,000. And we are saying that P has 30% in the associates. So in which case my unrealized profit is 30,000 and 30% of 30,000 is 9,000. So as per the Ind AS 28, this profit needs to be eliminated from the CFS of the investor company, and accordingly it has to be reduced from my cost of the investment. So entry would be my profit will be debited by 9,000 and investment associate will be credited by 9,000. We'll take another example wherein it's a vice versa. The transaction is now associate is selling goods to the parent. So typical example, 30% of the associate is holding by the parent. 1 lakh is the goods which is sold by the associate to the parent, and the cost of goods is 60,000. So my unrealized profit is 40,000. So my share of unrealized profit is 30% of 40,000, which is like 12,000 here. Again, the same entry is there. Share of profit to associates will be debited by 12,000, and then investment will be credited by 12,000. So even the profit is there in my associate, the treatment is same, because objective is that we cannot take the account for the unrealized profit. And what is not eliminated is the profit which is attributable to the non-investor share, and unrealized profit eliminated until inventory is sold. So which means that until my inventory is unsold, it is the share of the unrealized profit. The moment this is being sold to a third party, then in that case it will be re-recognized in my P&L. So it will be shown as an unrealized or reduced from my profits because it is unsold. So when it is sold, it will be again credited back to my P&L, and my cost of the carrying cost of the investment would be increased. So we'll move to the next slide. Okay, now we'll talk about what will happen if there is a discontinuation of equity method. So first of all, we need to understand why this discontinuation arises. So discontinuation occurs when the significant influence or the joint control is lost. So which means that it is a plain investment for an entity. It is no longer treated as a investment in the associate. So in which case, what will happen? Measure retained interest at the fair value. So whatever value we have for the percentage of the investment, we are going to measure at the fair value. We have to recognize the entire difference in the P&L. Any OCI balance related to the associate are reclassified to the P&L as it is entity has disposed of the investment. So which means that whatever differences in there in the final carrying amount, it has to be reclassified to my P&L, and we have to change the treatment and the method. From the equity method, it will be treated will be now being accounted at a fair value, and this treatment is absolutely aligned with the IAS 28. So we'll move to the final slide, which has a disclosure and the comparison between the IAS 28. Okay, so key items that needs to be disclosed as a part of the Ind AS 28 are the nature of the relationship, summarized financial information, carrying amount of the investments, commitments and the contingency, significant judgment in determining the influence. So these are like typical disclosure that needs to be disclosed as a part of the Ind AS 28. And if we try to do a comparison between the IAS 28 with Ind AS 28, this is largely the same. There is no gap. a few gaps which would be largely with respect to the form would be there. That would is largely because we are governed uh, by the Companies Act, and there are certain specifically regulatory measures specific which are there. But otherwise, conceptually, there is no gap and there is no deviation between the IAS 28 and the Ind AS 28. So this is the final slide. We'll move to the thank you slide then. Okay, so this is the final slide. So I would like to thank all my viewers and subscribers for watching this presentation till end. And it is my continuous endeavor to seek feedback from all my viewers so that we can make this more productive. And it is my request to please cascade this to all the aspirants who want to understand or refresh their knowledge for the Indias. So we'll come with the new Indias very soon. Till then, thank you, goodbye, and have a nice day.